In this example, we are using the effective interest method to record interest payments as well as the interest accrual. So you have in front of you the long-term liability section of Picados Corporation balance sheet. So currently their bonds payable have a carrying value of $230,000 based on the original issue amount less the balance of the unamortized bond discount. So we are going to prepare journal entries to record the interest payments of July 1st, December 31st, and January 1st of 2005, and we're going to assume an interest rate of 10%. So on July 1st, it's just going to be a normal journal entry that we learned previously in this chapter. We debit bond interest expense, credit unamortized bond discount, and credit cash. So remember that using the effective interest method, bond interest expense is calculated by taking your carrying value, which is $230,000, times your market rate, times 6/12 when interest is paid semi-annually. So that equals the $11,500. Then we calculate cash, which is the face value of the bonds, times the face rate, times 6/12, which equals $10,000. And then the balance in the unamortized bond discount is the difference of the two. Now on December 31st, we have to do an adjusting entry because there's been almost 6 full months, except the interest payment isn't actually going to be until January 1st. So we have to record the interest in 2014, even though we're not going to pay that interest until 2015, and even though there's only 1 day difference. The end of the fiscal year requires us to do an adjusting entry. So what we're going to do is we're going to calculate our bond interest expense again. So remember, the bond interest expense in a discount, the goal is to get the carrying value to equal the face value. So we take the previous carrying value plus the previous amount that was amortized, then times our 10%, and that gives us the $11,575. Cash doesn't change. Cash is still the $250,000 times the face rate times 6/12, which gives us the $10,000. Then the amount of unamortized bond discount is the difference between them. So I said cash, but since we are at the end of an accounting period and we're not actually paying until January 1st, we're going to put that amount into bond interest payable. It's an adjusting entry just like we would do with wages payable when we have to record it, but it's not going to be paid until the following accounting period. So then in step 3 on January 1st, what we're going to do is we're going to pay that. So we're going to debit the bond interest payable and credit cash to actually make the payment in the next accounting period.